We are looking at India's transition from a suspicion-based foreign exchange control model to a management-based facilitation model. In the suspicion-based era, simply holding foreign exchange was treated as an offense. Under the management-based model, dealing in foreign exchange is freely allowed unless expressly prohibited. This transition became law when FEMA 1999 came into force on June 1, 2000. On that specific date, the national approach to cross-border capital flipped entirely. Understanding this philosophical difference is the single most important advisory principle in modern cross-border transactions. We must first look at the Foreign Exchange Regulation Act, 1973, commonly known as FARA. The baseline presumption of FARA was strict. All foreign exchange transactions were presumed illegal unless specifically permitted. The consequences were severe. Possession of foreign exchange without permission was a criminal offense, punishable by imprisonment. The legal burden of proof rested entirely on the accused to prove their innocence. The Enforcement Directorate held vast powers of arrest and detention to police these restrictions. As a result, even routine business payments required advance approvals from the Reserve Bank of India. A chartered accountant operating under FARA functioned as a gatekeeper, navigating a rigid permission system on behalf of clients. The state's primary objective was the strict conservation of foreign exchange, prioritizing hoarding over business velocity. The transition from FARA to FEMA marked a direct shift from a criminal statute to a civil and economic framework. The presumption reversed. For current account transactions, everything is freely allowed unless prohibited. The burden of proof moved from the accused to the enforcement authorities. Penalties transitioned from imprisonment to civil monetary fines of up to 3 times the sum involved. The enforcement approach shifted away from police tactics towards an adjudicatory, civil process. The preamble of FEMA, 1999, explicitly states its objective: facilitating external trade and payments, and for promoting the orderly development and maintenance of the foreign exchange market in India. The law changed its goal from policing the economy to lubricating global commerce. This brings us to current account transactions. Under FEMA, these are completely free and require no RBI approval unless specifically restricted. This includes routine items like imports, services, travel, dividends, and interest payments. Conversely, capital account transactions remain strictly controlled and regulated. A capital account transaction is any action that creates a foreign asset or liability. This covers cross-border investment, borrowing, or lending. Your default rule for capital accounts is to assume prior permission or compliance is required, unless a regulation explicitly says otherwise. Therefore, your threshold task as an advisor is simply categorizing a transaction into one of these 2 buckets. This dictates the legal presumption. Let us apply this to an IT services company based in Bangalore. The company is paying a $15,000 monthly advisory retainer to a consultant in the United States. The CFO asks a standard operational question: do we need RBI approval for this payment? We classify the retainer. This is a payment for services in the ordinary course of business, making it a current account transaction. Section 5 of FEMA 1999 confirms that any person may draw foreign exchange for current account transactions unless restricted. Checking the negative lists, the FEMA Current Account Transactions Rules 2000 does not list advisory retainers as prohibited or restricted. The outcome is clear. No RBI approval is required. The AD Bank processes it upon submission of purpose, invoice, and Form A2. The transaction proceeds seamlessly without government gatekeeping, proving the efficacy of the management-based model. Note that permissibility under foreign exchange law does not grant tax clearance. The FEMA question of whether a payment is allowed and the income tax question of whether TDS is deductible require separate analyses. FEMA permits the $15,000 payment without approval, but compliance under the IT Act 1961 is mandatory. This requires a withholding tax analysis under Section 195 and the filing of Forms 15CA and CB. A high-caliber advisor runs dual, parallel analyses across both FEMA and the IT Act 1961 to protect the client. In practice, you will encounter friction. Bank compliance often lags behind statutory philosophy. AD banks frequently and incorrectly ask for RBI approval for routine current account service payments. Under Section 10 of FEMA 1999, The AD Bank is fully empowered and obligated to process these without RBI reference if the documentation is in order. Banks also tend to confuse current account transactions with capital account transactions. A royalty payment is a current account transaction. An equity investment is a capital account transaction. If a bank blocks a service payment citing capital account restrictions, their compliance team is overreading the regulation. Step in and issue a written memo to the client citing Section 5 of FEMA and the current account transaction rules. You are no longer a permission seeker from the RBI. You are an authoritative facilitator, and your written opinions